On the 1st of April this year, a temporary threshold that had kept stamp duty artificially low for first-time buyers and home movers across England for several years quietly expired, and the property market responded in exactly the way anyone paying attention might have predicted, with a frantic rush of completions in the weeks before the deadline, followed by a marked, measurable slowdown in the weeks immediately after. That pattern, a spike, then a freeze, is something the UK property market has experienced before every time stamp duty thresholds have changed, and it is something the market is experiencing again right now. I have been tracking the UK property market for years, and what makes this particular threshold change worth its own dedicated video is not the mechanical fact of the change itself, which was announced well in advance and came as no surprise, but what it has revealed about the underlying fragility of buyer demand at current price levels, and why the freeze that has followed is proving deeper and more persistent than the standard post-deadline correction most commentators predicted. In the next few minutes, I'm going to walk you through exactly what changed, what the market data is actually showing in the months since, and what this means for buyers, sellers, and anyone currently trying to time a move. Let's start with the numbers, because the scale of the impact varies enormously depending on where you are buying and at what price. A buyer purchasing at a price level that sat comfortably within the old temporary threshold faces a very different additional cost than a buyer purchasing at a price level in London or the South East that now sits clearly above the new, lower permanent threshold. The difference between what a first-time buyer pays in stamp duty on a flat price at the London average versus what they would have paid on the same flat 6 months ago is not a rounding error. For a significant share of first-time buyer transactions in higher price areas, the additional cost runs into several £1,000s, and that sum is payable in cash at completion, not folded into a mortgage, not spread across a term, just cash you need to have available on the day you get your keys. For buyers who have spent years saving a deposit to the absolute maximum of what they could manage, that additional cash requirement is not simply an inconvenience. It is a genuine financial barrier with real consequences for whether the transaction actually completes or collapses.
Let's now look at exactly what the threshold change involved, because the specific numbers matter. The temporary relief that expired in April raised the nil rate band for stamp duty, the threshold below which no stamp duty is payable, to higher levels than the standard thresholds that applied before the relief was introduced. For standard purchases, the nil rate band dropped back down from the temporary elevated level to the standard rate threshold. For first-time buyers who benefit from a separate additional relief, the threshold above which full first-time buyer relief no longer applies also fell back, meaning first-time buyers purchasing at prices above the lower standard threshold now face a stamp duty bill that they would not have faced under the temporary arrangement. In practical terms, for a buyer purchasing at certain price points in the London and South East market, where these thresholds interact most significantly with actual transaction prices, the change has added several £1,000s to the upfront cost of a transaction that was already stretched to the limits of most buyers' available cash at completion. Red flag number 1, the timing problem that created a false demand peak followed by an artificial trough. In the 3 months leading up to the April deadline, estate agents and conveyancers across England reported an extraordinary concentration of completions, as buyers who were already in the process pushed to exchange and complete before the threshold dropped, and as some buyers who had been hesitating accelerated their decisions specifically to lock in the lower cost. That concentration of demand produced misleading transaction volume and price data for the months of January, February, and March, creating a picture of market activity that overstated the underlying level of genuine sustainable demand. The months immediately following the deadline have then shown the opposite distortion, a trough in transaction volumes that reflects not a sudden collapse in buyer interest, but the statistical reality that a meaningful share of deals that would normally have completed in April, May, and June were pulled forward into the preceding quarter. Separating the genuine underlying trend from the statistical noise created by this timing effect is genuinely difficult, and a number of commentators have been caught making confident claims about post-deadline market performance based on data that is still dominated by the deadline distortion rather than underlying fundamentals.
Red flag number 2, the cash flow crunch at completion that is proving more disruptive than most buyers anticipated. Stamp duty is payable at the point of completion, not spread across a mortgage term. For buyers who stretched their finances to the limit of their available savings to assemble a deposit, the additional stamp duty cost created by the threshold change represents a cash flow problem that cannot simply be absorbed without consequence. Estate agents and mortgage brokers describe a meaningful uptick in cases where buyers who'd agreed a purchase under the old threshold assumption have found themselves needing to renegotiate the purchase price downward after the April change to recover the additional stamp duty cost from the transaction itself rather than from savings that simply are not there. In some cases, those renegotiations have succeeded. In others, the seller has refused, the buyer has withdrawn, and the chain has collapsed, contributing to a post-deadline spike in fall-through rates that conveyancers describe as meaningfully elevated above the normal baseline. Red flag number 3, the disproportionate impact on the London and South East market, where transaction prices interact most severely with the new thresholds. The stamp duty system applies uniform thresholds across England, which means that practical impact of any threshold change is not evenly distributed geographically. In most of the country, a first-time buyer can still purchase a reasonably typical entry-level property within or close to the threshold bands, and the change represents a modest, manageable additional cost. In London specifically, and across much of the South East, entry-level transaction prices frequently sit at levels where the threshold change adds a materially larger sum to the transaction cost, in some cases several £1,000s, representing a genuinely significant additional barrier for buyers who are already being stretched by a combination of high prices, elevated mortgage rates, and the deposit requirements I have covered extensively in previous videos on this channel. The areas where the freeze is deepest are, almost without exception, the areas where transaction prices interact most sharply with the change thresholds.
Red flag number 4, the seller resistance that is preventing the price adjustment the market needs to fully clear the additional cost. In a simple, frictionless market, a stamp duty increase that adds cost to a transaction would over time be absorbed through a modest downward adjustment in transaction prices, as buyers factor the additional cost into the maximum price they are willing to pay, and sellers accept that the new market clearing price is somewhat lower than the old one. In practice, the UK property market adjusts far more slowly than this model predicts, because sellers, anchored to a specific price expectation based on what comparable properties achieved before the threshold change, are frequently unwilling to accept less, even when the buyer's total cost at the new price level is genuinely higher than it was at the old one. The result is a stalemate. Sellers holding at prices calibrated to a pre-change cost environment, buyers unable or unwilling to meet those prices given the additional stamp duty, and transactions simply not happening, with both parties waiting for the other to move first in a standoff that can persist for months.
Red flag number 5, the knock-on effect on the second-hand market from the disproportionate freeze at the first-time buyer end. First-time buyers are not just buyers of their own homes, they are the foundation of the entire transaction chain, the people whose purchases allow existing owners to sell and move up, freeing properties at each level of the market for the next buyer below them. When first-time buyer demand slows, the effect cascades upward through the market, as second and third-time movers find that the buyers for their current homes are fewer, slower, or more price-sensitive than they expected, extending their own sale timelines and, in some cases, forcing price reductions that nobody in the chain initially anticipated needing to make. This cascade effect means that the freeze created by the threshold change is not limited to the first-time buyer segment, where the impact is most direct, but spreads upward through the market in ways that eventually touch transactions at price points well above the thresholds themselves. Now here is the part that connects all of these red flags together, and it is worth stating plainly. Stamp duty changes do not create underlying demand, they shift it in time. The rush before the deadline and the freeze after it are two halves of the same distortion, and the market that emerges from this adjustment period will eventually settle at whatever level genuine sustainable demand at current prices and current mortgage rates actually supports. The stamp duty change has not destroyed demand, it has revealed that demand at pre-change price levels and post-change cost levels was more fragile than the temporary threshold had made it appear, and the freeze that has followed is, in part, the market discovering its own genuine level after a period in which an artificial cost reduction had been quietly flattering the transaction figures.
I spoke with an estate agent who operates across several southeast markets, and off the record her assessment was blunt. She said the weeks immediately after the deadline were among the quietest she had experienced in years, and not simply because completions had been pulled forward. She said the pipeline of new instructions and new agreed sales was also markedly thinner than normal, as sellers who had been planning to list decided to wait and see whether the market adjusted, and buyers who had been close to committing stepped back to reassess whether their numbers still worked. She said the freeze is not a wall, deals are still happening, but they are taking longer, requiring more negotiation and collapsing more frequently, in a way that represents a genuine step change from the market conditions that prevailed in the 12 months before the threshold change.
She described one specific pattern she is now seeing repeatedly, which is buyers who were already agreed on a price before the deadline, but whose completion date slipped past April, arriving at the point of exchange having discovered that their cash position at completion is now tighter than their original calculation assumed, because the stamp duty liability that was baked into their original numbers was based on the old threshold. In a number of cases, she said, those buyers have come back to ask for a price reduction that the seller has refused, and the transaction has subsequently fallen through, not because anything is wrong with the property, not because the buyer's mortgage has failed, but simply because a change in the government's stamp duty schedule arrived between offer and exchange, and nobody in the transaction had properly modelled the cash flow impact of that specific scenario.
So, what does this actually mean if you are buying, selling, or waiting? First, if you're a buyer, build the current stamp duty liability into your affordability calculation from the outset rather than as an afterthought, and be specific about whether your cash reserves at completion cover both your deposit and your full stamp duty bill, without requiring any last-minute renegotiation of the purchase price. Second, if you're a seller, price your property relative to the buyer's total cost of acquisition at current stamp duty rates, rather than at the price comparable properties achieved before the threshold changed, because a buyer's maximum affordable price is now structurally lower than it was, and pricing as if nothing has changed is the single most reliable way to sit on the market without selling. Third, if you are in a chain, identify the weakest financial point in the chain, specifically in relation to stamp duty exposure, because that is the point most likely to generate the kind of fall-through or renegotiation that collapses the whole arrangement, and address it directly and early, rather than hoping it works itself out closer to completion. Fourth, if your transaction is currently stalled, ask your estate agent directly whether the specific stall point relates to stamp duty cost rather than any issue with the property itself, because the remedy for a stamp duty-related stall is often a targeted price adjustment rather than any more fundamental renegotiation. Here is how I expect this to develop over the next several months. Expect transaction volumes to recover gradually as the timing distortion from the deadline rush works its way out of the data and genuine underlying demand reasserts itself. Expect prices in the most affected segments, particularly first-time buyer properties in London and the South East at the threshold-sensitive price points, to soften modestly as sellers gradually adjust to the new cost environment facing buyers. Expect continued political pressure for either a permanent raising of thresholds or a specific relief targeted at the market segments most affected, though the fiscal environment makes any near-term reversal of the threshold change unlikely without an offsetting measure elsewhere. And expect the freeze to persist longest in the segments where it has bitten hardest, the first-time buyer market in high-price areas, where the interaction between transaction prices, mortgage affordability, and stamp duty costs is most acute and most resistant to quick resolution. It is also worth watching how this plays out specifically for the new build market, which I have covered in detail in previous videos on this channel. New build developers, who were already offering significant financial incentives to shift unsold stock before the threshold change, are now facing a buyer pool that is further squeezed by the additional stamp duty cost, and the developer incentive packages being structured in the months after the deadline increasingly include contributions towards stamp duty, as well as the cashback, rate reducer, and legal fee packages that were already common before April. A developer willing to cover a buyer's stamp duty liability is in effect absorbing the cost of the threshold change themselves rather than passing it to the buyer, which is a significant commercial concession that tells you something clear about how difficult conditions have become in the new build market specifically. There is also a longer-run question about whether this threshold change, combined with the broader affordability pressures I have covered extensively elsewhere on this channel, produces a structural rather than cyclical shift in the first-time buyer market in higher price areas. If the threshold change proves to be the additional straw that pushes a meaningful number of first-time buyers in London and the South East toward either delaying their purchase further or relocating to lower price areas where their budget achieves more, the impact of the change extends well beyond the immediate transaction data into the longer-term composition of who is buying in which markets and at what price levels. a structural shift that, once established, tends to be slow to reverse, even when the specific policy trigger that caused it is eventually addressed. The uncomfortable truth underneath all of this is that stamp duty changes are one of the bluntest and most distorting tools available to any government seeking to manage the property market, creating timing effects that produce misleading data, concentrating cost on buyers who are already the most financially stretched, and interacting with mortgage affordability in ways that can freeze entire market segments without any corresponding benefit to either buyers or sellers. If you are navigating this market right now, the most useful thing you can do is ignore the headline transaction data, which is still heavily distorted by the deadline effect, and focus instead on the specific numbers for your own transaction, your own stamp duty liability, your own cash position at completion, and your own realistic price relative to what buyers in your segment can genuinely afford to pay today, rather than what they were paying 6 months ago.